Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. This week, we take a look at how Warren Buffett seeks out investing opportunities while investing with small amounts of money. I was thinking the other day about how Warren Buffett is mostly known for his multi-billion-dollar investments into companies like Apple and Bank of America. But contrary to popular opinion, it wasn't always this way, and just like you and me, he had to start out quite small too. In 1995, he was asked at his annual shareholder meeting what advice he would give to those working with small amounts of money, just like he once had to do as well. And he gives us his response. The interviewer, Howard Lowe, asked, and I quote, "Mr. Buffett, you indicated that you were talking about the problems of compounding large size, which I appreciate and understand, but also indicated that you're confident that if you were working with a sum closer to $1 million, that you could compound that? That at a 50% rate for those of us who aren't saddled with $100 billion problems. Could you talk about that and what types of investments you'd be looking at and where in today's market you think significant inefficiencies exist?" Warren Buffett responded back saying this, "I think I may have been very slightly misquoted, but I certainly said something to that effect. But working, I think I talked about this group I get together every 2 years and how I poll that group as to what they think they could compound money at with $100,000, $1 million, $100 billion, $1 billion, and other types of sums, and I pointed out how this group of 60 or so people that I get together with every couple of years, how their expectations of return would go very rapidly down the slope. It is true, I think I can name half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million. Have that as an expectation if they needed it. I mean, if they'd have to get their full attention to be working on that sum, and those people could not compound money 100 million or $1 billion or anything remotely like that. I mean, there are little tiny areas which you can start with. You can go through and look at everything and you will find small securities in your area of competence that you can understand the business. I think, and you can occasionally will find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as money compounds. Because from $1 million to 10 million, I would say it would fall off dramatically because there are you can find very small things that you can make. You're almost certain to make high returns, but you don't find very big things in that category today. I'll leave you the fun of finding them yourself. I mean, terrible to spoil the treasure hunt, and the truth is I don't look for them anymore. Every now and then I'll stumble into something just by accident, but I'm not in the business of looking for that. I'm looking for things that Berkshire could put its money in, and that rules out a lot of that sort of thing." Charlie also added, "I would agree, but I would also say that what we did 40 or so years ago was in some respects more simple than what you're going to have to do right now. We had it very easy compared to you. It can still be done, but it's harder now. You have to know more. I mean, just sifting through the manuals until you find something that's selling at 2 times earning, that won't work for you. Well, it'll work, but you just won't find any. So now let's elaborate and talk about some of the key points that Warren Buffett and Charlie Munger talk about in this video. Now, the first point here is that Warren Buffett believes that he knows about 6 people who could compound 1 million every single year at 50% growth rate. Now, this is quite a small amount of people, which means that it's probably very difficult, but it's also not impossible. He also says that those same 6 people could not compound $100 million or $1 billion at that same growth rate. This essentially means that it's easier to get the great return when you're working with smaller amounts of money. And when you get up into that $10 or $100 million range, you're not going to get a great rate of return nearly as easily, as this is simply because we have to take the volume of stock into consideration. So for example, if there's a stock that's worth about $1 per share and it only trades at about 100,000 shares a day, it means that there's only a total of about 100,000 trading hands in that one given security. Which means that if you want to throw 1 million into that stock, it's going to take some months to build up your full position. So the larger sums of money that you have, the harder it is to execute these smaller stock opportunities, simply because they do not trade as much volume and there's not that much money changing hands in that one company. But again, there are great opportunities to grow money extremely quickly in these small companies. Here's Warren Buffett's second point. He says to find small securities in your own area of competence, and Warren Buffett also likes to refer to this as your own circle of competence. What your area of competence is simply an area of the market or an industry that you believe that you are personally very knowledgeable about, and this could be because you work in the industry or you just know some more about that overall business model that makes you have a little bit of competitive advantage over other investors who are looking into the space. Staying within your own circle of competence may also give you opportunities that other investors might miss out, simply because you know a little bit more about the industry. Warren Buffett himself stays within his circle of competence, and this is why we consistently see him invest in oil companies and financial institutions like Bank of America. And remember that Warren Buffett always recommends staying within your own circle of competence, whether you're investing into small security or a large cap company. So this really applies to all investing, no matter what you're looking at. Now moving on to the third point. His advice is to occasionally find wrinkles in the market, and what Warren Buffett means by finding a wrinkle in the market is to simply find a stock that the market is mispriced. Therefore, creating a little wrinkle that we can take advantage of, and this does happen from time to time, and this is likely to happen more in smaller cap companies after they experience quite large sell-offs. These sell-offs cause these smaller companies to sell way below book value and have extremely low financial ratios. There are, in fact, sometimes these little wrinkles on the market where you can identify them and get stocks for incredibly cheap. Now, finding these little wrinkles takes some time, and it can be quite difficult, but as Warren Buffett says, if you can find these wrinkles, and they can provide you with some great opportunity to get some high returns. Moving on to the fourth point, he says, when working with small sums of money, there is an opportunity for a high rate of return. And we talked about this a little earlier on the video, but now let's talk about specifically why this is. There are three main reasons for this. The first reason is hedge funds and analysts do not pay attention to smaller securities because they can't invest their large sums of money. So, like Warren Buffett, they don't even look or pay attention. The second reason is this lack of coverage means that there are less people aware of these undervalued opportunities, which essentially means there is much less competition. And the third reason is there is not much media attention around these small companies, and many people avoid them altogether because they are seen as speculative investments. So to summarize, there is much less competition in these smaller securities because these large institutions can't even invest in them, so they just avoid them altogether. And with less eyes looking at this means that there is potentially more opportunity to find undervalued securities. And for those of you who may not know, Warren Buffett actually purchased 100% of the company See's Candy for only $25 million back in 1972. An article gives us a little bit of deeper insight into how this small cap investment played out for Warren Buffett in the case study, which I'll link to in the description below. It says, Berkshire Hathaway bought See's Candy for $25 million in 1972. The year it had roughly $30 million in sales and bought in $4.2 million in profit. As a result of its small size, we can't track its results over the decades, but 35 years later in 2007, Buffett noted sales had risen nearly 13 times to stand at $383 million. Even more impressive, Buffett revealed profits were up nearly 20 times and stood at $82 million. That means Berkshire now earns nearly 3 times the cost of its original investment each year. But perhaps what is even more remarkable is that in 2011, Buffett and Sees had brought in a staggering $1.65 billion in total profit since he bought it 40 years ago. Warren Buffett saw an opportunity with a company that was only worth about $25 million, and he did not let this small market capitalization or the fact that it was just a small company deter him from seeing the great opportunity. And he ended up buying the entire company, and now, it says in the article, Berkshire earns nearly 3 times the original cost of the investment every single year. So this has played out wonderfully for Berkshire and Warren Buffett. Also, when these smaller companies go on to become a billion-dollar company or multi-billion-dollar company, then these institutions can start investing in them and to start paying attention to them. And when these institutions start getting involved, then there is much more media coverage involved. And there is more media coverage, more analyst coverage, and all around more eyes on the stock, which means that the valuation goes up when more people start getting involved. But now let's move on to the 5th point, which is that Warren Buffett does not pay attention to smaller companies anymore. Since Berkshire Hathaway handles a lot of the money now, and even if they found smaller companies that seems to be a great opportunity, it wouldn't be worth their time to throw money at it. Berkshire Hathaway simply focuses on multi-billion-dollar industry now because this is where they can actually deploy a significant amount of Berkshire Hathaway's capital. And again, this is why there is so much more opportunity in these smaller securities. It's because these large hedge funds aren't paying attention to these low asset class businesses. The 6th and last point is from Charlie Munger when he said it was easier to find these opportunities 40 years ago. This is simply because 40 years ago, how they found stocks was by flipping through books and reading manuals, like the Moody's manual. And I'm sure that 40 years ago, not too many people were doing this. And since there weren't that many people doing it, it means that there wasn't a lot of competition to find these undervalued smaller companies. So again, it all comes down to competition and how many people are actually looking for these opportunities. In today's world, anyone with a stock trading platform has access to what we call stock market screeners. What these screeners allow you to do is put in the specific information that you're looking for in a new investment, and these screeners will screen the entire stock market and allow you to find stocks within your range very quickly and efficiently. So essentially, now that everyone has access to screen the entire market within a few seconds, it's getting harder and harder to find undervalued securities, but they are still out there. So to summarize, a lot of investors today think that these smaller cap companies are too speculative to pay attention to, and in reality, they're not. These smaller companies are simply just smaller businesses that are overlooked by Wall Street because institutional investors cannot put their money in them, but there are still great, wonderful businesses in small cap land. As an example, we saw Warren Buffett bought See's Candy for only $25 million, and you can see how great that investment turned out for him. So personally, I believe that if we apply all of the same investing principles to those smaller companies, then we can potentially find some great opportunities. So don't write off these smaller cap companies as pure speculation without doing additional digging into the actual company, the management, and applying all of these great investment principles that you would apply to any other investment. Now, obviously, not all small cap stocks are going to be great companies, and you will want to apply all of the same great investing principles that you would apply to looking at larger cap investments. But these small cap opportunities come from them being overlooked by institutional investors and investors in general from thinking that they're just too speculative, even though they are truly wonderful businesses. Here are the key points that Warren Buffett and Charlie Munger talked about in this video. Number one, there are really 6 people he thinks that could compound $1 million every single year at 50% growth rate. Number 2, the same 6 people could not compound $100 million or $1 billion at that same growth rate. Number 3, you should find small securities in your own area of competence. Number 4, you can occasionally find wrinkles in the market. Number 5, when working with small sums of money, there is an opportunity for high rate of return. Why? A, hedge funds and the analysts do not pay attention to smaller securities because they can't invest their large sums of money. This lack of coverage means that there are less people aware of these undervalued opportunities, which essentially means there is much less competition. C, not much media around these small companies, and many people avoid them altogether because they're seen as speculative investments. Number 6, Warren Buffett doesn't even pay attention to smaller companies anymore. Number 7, it's easier to find these low-hanging fruit opportunities 40 years ago. I hope you enjoyed this week's investing advice from Warren Buffett. Please consider subscribing to my channel. Also, if you enjoyed this video or you found it helpful in some way, please remember to leave a like on it. This really helps my channel grow. So, like this video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.